Welcome to your daily Solo 401k webinar and Q&A session with my Solo 401k Financial, where we help you to stop overpaying taxes and start building real retirement wealth. Today's topic is, does Edwards Jones Solo 401k support Mega Backdoor Roth? Here's how to set it up. This is your chance to get answers. Please use the chat to ask questions on today's topic or anything else. Please chat them over now so that we can be sure to get to them all. Let's get started. So as always, the presentation is being provided for educational purposes only. It should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. Let's start out with the foundation of Solo 401k eligibility fundamentals. So what is a Solo 401k? It's a retirement plan for self-employed individuals. So in order to be eligible, you need to have self-employment income. So for example, that could be income reported on Schedule C if your business is taxed as a sole proprietor, or income reported on a W-2 if your business is taxed as an S Corp or a C Corp, as well as income reported on line 14 of a K-1 in the event that your business is taxed as a partnership. So you need to have that earned self-employment income with no non-owner, non-spouse, full-time W-2 employees. So in other words, you and your spouse could be an employee, but you can't have other individuals that are not owners of the company as full-time W-2 employees. If you meet those eligibility criteria, then you would be eligible to establish a Solo 401k. Now, one of the top reasons that clients set up accounts with us is the ability to make Mega Backdoor Roth contributions. So let's define what a Mega Backdoor Roth contribution is. It's an advanced strategy to maximize Roth contributions. So for example, your Roth IRA contribution limit is $7,000. With a Mega Backdoor Roth contribution, individuals are going to be able to contribute up to 10 times that, $70,000, or even more if they're age 50 or older for 2025. So the mechanics of making a Mega Backdoor Roth contribution is really a two-step process. So you first need to make what's called a voluntary after-tax contribution, and the voluntary after-tax contribution limit is much higher than your standard, say, employee contribution limit, which, for example, is $23,500 for 2025. Step two, then, is to move those voluntary after-tax Solo 401k contributions either to a Roth Solo 401k or a Roth IRA, where they'll be just like any other Roth money in that account, where it has that potential for tax-free growth. The crux is that you need to have plan documents that allow for both steps. In other words, you need to have a Solo 401k plan that, number one, allows for voluntary after-tax contributions, and then number two, allows for the transfer of those voluntary after-tax Solo 401k funds either to a Roth Solo 401k or Roth IRA. So now the question is, okay, does Edward Jones Solo 401k support the Mega Backdoor Roth? And the answer is no, it doesn't, but they will still open up accounts for a third-party plan that does allow for the Mega Backdoor Roth. So that's the key in being able to unlock the Mega Backdoor Roth through an account at Edward Jones. So Edward Jones offers their own basic, what they call owner-only plan, but their plan documents do not support the voluntary after-tax contributions, do not support the in-plan conversions. So if someone has their owner-only plan through Edward Jones, they're not eligible to make Mega Backdoor Roth contributions. But Edward Jones will still open up accounts that are governed by third-party Solo 401k plans, like the one offered by my Solo 401k Financial that does support the Mega Backdoor Roth. So that's the key. You can have your accounts at Edward Jones, but have the plan documents through a third party. So why a specialized Solo 401k provider is necessary? Well, at the basic level, at a minimum, it's because you need those plan documents that are going to allow for the two-step process of making Mega Backdoor Roth contributions. First step, making the voluntary after-tax contributions. Second step, doing the Roth conversion, either to a Roth Solo 401k inside the plan or out of the plan to a Roth IRA. Now, it's going to make sense to work with a company like my solo 401k financial that not only meets that basic requirement, of course, having a plan document that allows for mega backdoor Roth contributions, but also working with a company like my solo 401k financial that has deep experience in guiding clients through those required steps. Deep experience, for example, in answering questions in terms of the contribution limits and the deadlines and the mechanics, as well as a company like my solo 401k financial that provides all the ongoing compliance support as an optional free service, which we do. So when you make that first voluntary after-tax contribution, that doesn't need to be reported on the personal tax return or the business tax return. That doesn't need to be reported on the W-2, for example, if your business is taxed as an S Corp. But the second step, when the funds are moved from the voluntary after-tax account to either a Roth solo 401k or a Roth IRA, that is reportable by the plan on a Form 1099-R. And as mentioned, we handle that as an optional free service. Customers just have to let us know about that after-tax to Roth transfer so we can capture the information needed to prepare the 1099-R. For example, we have a form on our website that customers can use 24/7 to provide us that information. So a question will come up, okay, well, I already have an owner-only plan at Edward Jones. Can I upgrade my plan to a plan offered by my solo 401k financial in order to be able to make mega backdoor Roth contributions? And the answer is yes. As a matter of fact, it's very common that customers start out with a basic plan somewhere else and then upgrade their plan to our plan. So that process is referred to as a restatement. So it's not as if the individual is shutting down their basic solo 401k plan, say their basic owner-only plan at Edward Jones, and then starting up a new plan with my solo 401k financial. No, the plan itself will continue, but the documents that govern it, those plan documents, those basic plan documents that currently govern the account, that are currently provided by Edward Jones, which don't allow you to do what you want to do. In other words, they don't allow for the mega backdoor Roth solo 401k contributions. Those plan documents can be replaced with our plan documents, which do allow for the mega backdoor Roth contributions. And now the individual would be a client of ours, so we can provide all that ongoing compliance support that we described up above. In addition, it's noteworthy that if someone upgrades their plan to our plan, they're also going to be able to take advantage of other benefits that are not available under the owner-only plan offered by Edward Jones. For example, our plan will enable the self-employed individual to claim $1,500 in solo 401k tax credits. That's $500 per year for 3 consecutive years. So those credits are available not only to new plans, but also to upgraded plans that now include the auto enrollment feature, which needs to be enabled, as well as the other notices that need to be prepared in order for the self-employed business to be able to claim the credits. So those credits are going to more than cover our fees for the first 7 years. We charge $650, which is the initial fee. That includes the $525 establishment fee, plus the first $125 annual fee. Then starting 12 months later, we charge our $125 annual fee that covers the second year. So those $1,500 in tax credits will more than cover our fees for the first 7 years, because that's a tax credit, not a tax deduction. So it'll be a dollar for dollar reduction in the individual's tax liability. Other features include the solo 401k loan feature. That's another feature that's not available under the owner-only plan provided by Edward Jones. So with a solo 401k loan feature, the solo 401k participant can borrow from their own solo 401k account, literally transfer funds out of the account to themselves. They can use the proceeds for any purpose that they want, whether a personal purpose or an investment purpose. And it's not going to be subject to taxes or penalties as long as it's within the solo 401k loan terms. So they can borrow up to 50% of the balance, not to exceed $50,000, and paid back according to the loan terms, as well as documented. We prepare the required loan documents as part of the service for no additional charge. And those repayment terms are going to require that the loan is paid back in either monthly or quarterly payments, equal payments of principal and interest. The interest is prime plus 1%, or it could be a CD rate plus 2%, with those payments spread over a 5-year term. Other services and features would be the fact that we also offer free optional IRS Form 5500EZ electronic filing. That will apply once the value of the plan, including the value of any defined benefit plan that might be sponsored by the self-employed business, once the value exceeds $250,000, there will be an informational filing requirement that applies to the plan. And the name of that informational filing is referred to as a Form 5500EZ. Again, we provide that as an optional free service, and we file it in that case under the electronic filing system. Customers just have to let us know once the value exceeds $250,000 so we can add their plan to the queue to be able to prepare that 5500EZ. Invest in alternative investments. So our plan will, of course, not only allow for typical brokerage type investments that are available through Edward Jones, as well as true alternative investments, such as real estate, private equity, crypto, pre-IPO opportunities, just to name a few. Flat fee administration versus percentage of asset fees. So with our plan, we just charge a flat fee. As I mentioned, we charge $125 per year, regardless of the value of the account. So the $650 establishment fee, and then $125 a year starting 12 months later. All right, thank you so much for letting me go through those slides with me. We do appreciate the chance to share this information. We're going to turn to the questions here now. Real quick, if this information is helping you feel more confident about your future, please take 1 second to like and subscribe. That'll tell the platform that the content is valuable, so that'll help get the word out to other solopreneurs just like you. Subscribing will guarantee that you get notifications of all of our crucial content that we deliver every day to help you secure your retirement. Hi there, Sean. Thanks for joining. Can my voluntary after-tax contributions to a solo 401k be transferred to my Roth IRA, not limited to just a Roth 401k? Absolutely. So the general rule is that one cannot transfer funds out of their solo 401k until they've met a triggering event. For example, being age 59 and a half or older. But one of those exceptions to the general rule are voluntary after-tax contributions. So voluntary after-tax contributions can be transferred out of the solo 401k to a Roth IRA without having to meet a triggering event. So when you make a mega backdoor Roth contribution, you first deposit the voluntary after-tax funds to a separate voluntary after-tax account, and then you either transfer the funds to a Roth solo 401k or you transfer the funds to a Roth IRA. So now they can grow on a potentially tax-free basis. That is the point at which a 1099-R would have to be issued, or for that point, it would be issued by the following year. So that is the point at which customers will let us know about that after-tax to Roth transfer so we can capture the information needed to prepare the 1099-R. Are there any unforeseen tax consequences, such as the pro rata rule associated with an in-plan conversion of after-tax solo 401k funds to a Roth IRA, particularly for someone like me under the age of 59 and a half? Another great question, Sean. Thanks for bringing it. So that's not an uncommon question, because a lot of folks' experience with the backdoor Roth comes from the backdoor Roth IRA context. In that backdoor Roth IRA context, one needs to look at all the IRA account balances they have to determine the impact of the pro rata rule. Whereas with regards to a 401k, the pro rata rules apply at the account level. Therefore, and this is why funds are held in a separate voluntary after-tax solo 401k account, so that they can just be moved from the after-tax account either to a Roth solo 401k or a Roth IRA, notwithstanding the fact that the individual might have other types of funds in their solo 401k, such as other funds in their pre-tax account or other funds in their Roth solo 401k account. Great question. All right, let's go to the next one. Can I add my wife to my solo 401k plan so that she can make profit sharing match an employee contribution? Does she need to be a trustee of the plan? What if she's only a W-2 with my firm? Another great set of questions, Sean. Thank you so much. So yes, a solo 401k is a one participant plan, and an exception to that one participant rule is a spouse who's working in the business and reporting the spouse's own earned self-employment income. So in the case of a self-employed business taxed as an S corp, the spouse is receiving W-2 wages as well from the self-employed business. In that case, the spouse can participate in the solo 401k plan. Now, the spouse does not need to be an owner of the business in order to be eligible to participate in the plan. The spouse would need to be added as a trustee of the plan, and then the spouse would be able to make contributions based on their W-2 wages, as well as the other factors like the spouse's age, the type of contributions the spouse is looking to make, whether the spouse makes contributions to another plan, etc. Now, of course, our plan does allow for employee contributions as well as profit-sharing contributions, but technically those are not matching contributions, but they're what they're called profit-sharing contributions. So unlike a matching contribution, where a prerequisite of the matching contribution is that an employee contribution is made in elective deferral, which is then matched. With a profit-sharing contribution, a profit-sharing contribution can be made regardless of whether a elective deferral is made. So in that way, it's actually more flexible than a matching contribution. Are the credits available for LLC owners with Schedule C as well, or just the S Corp folks? Another great question, Sean. Thanks for bringing it. So yes, the credits are available regardless of how the self-employed business is taxed. The key is having a solo 401k plan like the one offered by my solo 401k Financial that includes the auto enrollment features, as well as the other required notices, etc., that we prepare automatically as part of the establishment process. Can I open multiple 401k accounts with different custodians, Schwab for traditional and someone else for alternative investments? Great question, Sean. The answer is most definitely. So an individual will have one plan, meaning one set of plan documents, but they may open multiple accounts, whether at the same custodian or even different custodians. Like many individuals who want to, for example, invest in alternative investments will have a bank account to facilitate those alternative investments like real estate, et cetera, but then also want to have some of their solo 401k funds invested in brokerage type investments for which they will need a brokerage account, because you can't invest in a mutual fund, for example, through a bank account. And it's certainly no problem. You can have both bank and brokerage accounts. You can transfer funds between bank and brokerage accounts. And as long as it's the same like-to-like transfer, for example, pre-tax brokerage to pre-tax bank, it's not reportable, it's not taxable, you can definitely do it. Wonderful. Next question. I understand that my solo 401k Financial documents do not allow for the Rule 55, but I'm curious why when it's possible for one spouse. So our plan documents do, as a matter of fact, allow for the Rule of 55. It's just that it's very rare that it's done, because typically that's going to entail shutting down the self-employed business. But that's really the exception that you're hitting on, is a two-spouse scenario where one spouse reaches the age of 55 and the other spouse continues to and separates from service, and the other spouse continues to maintain the self-employed business and therefore continues to maintain the solo 401k. So as a matter of fact, it does. So yes, that could be done. That's really the exception. But as mentioned, and maybe something that you read, it's virtually never done, because for most folks, they would need to shut down their self-employed business. Thank you for the great questions. So as a follow-up, so I need to add my spouse as a trustee to my plan. Yes, if the spouse is not already a trustee. In case of multiple accounts with different custodians, we need you to provide you statements info for the Form 5500. Well, once the value of the solo 401k plan, including all accounts, investments, including the value of any defined benefit plan that might be sponsored by the self-employed business, exceeds $250,000, clients need to let us know if they want us to help prepare the 5500 EZ, in which case we would add their plan to the queue. Then we would reach out to them in the first part of the year, because the 5500 EZ is due by July 31st of the following year. So in the first part of the year, we would reach out to them to gather the information we need to be able to prepare that 5500 EZ. So it's an online questionnaire where we're capturing that financial information that needs to be reported on the 5500 EZ. So customers don't need to provide us statements, but rather the sum information, right? The bottom line information, the value of the plan at the end of the year, et cetera. Awesome. Thank you. Thank you so much. All right. Looks like that takes us to the end of the questions. We'll give you a moment to see if any more questions come across. Thank you so much for the great participation. In the meantime, we'll invite you to our community. We have the largest community of solopreneurs and solo 401k owners with over 30,000 members, which means that we have vibrant forums. We have a library of videos and webinars. So there's tons of ways to learn and to share the knowledge. It's totally free to join, and you can join easily at mysolo401k.net/my community. All right, well, that's it then for today's Solo 401k session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this community. We'll be back tomorrow with more crucial content to help secure your retirement. All right, one question snuck in at the end. Let's take it. Thank you so much. I have a law firm with another lawyer. I have one paralegal in that firm that is going to be joining me in a new company I'm setting up. That company will just do mediations. No one will be in that company. Do I qualify for the solo 401k? That's a good question. It depends on whether those two companies constitute either a control group or an affiliated service group. So control group will depend on your relationship with that other person. For example, if they're your spouse, then their ownership would be attributed to you. So it's as if you own 100% of the law firm. And I assume that that's the entity that has, for example, full-time W-2 employees. But even if your ownership is below the percentage that's required to create a controlled group, and if you have a controlled group or an affiliated service group, if there are W-2 employees in that law firm, that would prevent you from setting up a solo 401k for the other company that's part of the control group. Control group is really a mathematical test, right? Looking at the ownership percentages, whereas affiliated service group is more of a facts and circumstances analysis. So you definitely need to work with your tax advisor to determine, because the consequences could be severe if you set up a solo 401k and you're not able to do so. So affiliated service group is going to look, for example, among other potential factors, whether or not those two businesses are interacting, which they very well might be, it sounds like, because, for example, the law firm might be referring mediations to the other company that's just you. So if those companies constitute an affiliated service group, even if it's just you, there's no employees in the mediation company, the fact that there are W-2 employees in another company that's part of the affiliated service group will prevent any company that's within that affiliated service group, including the mediation company, from setting up a solo 401k. It's still going to be not just something just answer on the fly. You would definitely want to work with your tax advisor to assess. That would be the prudent course, just to make sure that there isn't either an affiliated service group or a control group there. You could reach out to Stephen Hamilton. He's on our community. I believe his website is hamiltontax.net. And my understanding is that he may be able to help you with that. No, we do not give tax advice. Okay, thank you so much, everyone. Have a good one.